If you don't know who Dave Ramsey is, he is an American personal finance radio show host and author. His radio show runs on more than 500 radio stations. He also has a YouTube channel with well over 1 million subscribers. Dave is reaching a huge audience, not just in the United States, but around the world. Dave Ramsey's advice on investing is not very good. The things that Dave Ramsey tells you to do with your investments are at odds with both the current academic literature and the empirical evidence. I don't doubt that Dave has helped lots of people get out of debt, start saving, and feel more confident about their money, which are all good things. But his advice on investing should be avoided at all costs. I'm Ben Felix, Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you why I fundamentally disagree with Dave Ramsey's advice on investing. I see no better way to approach this video than discussing the many flawed statements that Dave Ramsey has made about investing. I want to be clear that this is in no way commentary on Dave Ramsey's character. It seems like he is genuinely dedicated to helping his audience. My intention here is to educate you on the factually incorrect statements that Dave Ramsey consistently makes about investing, and why those statements could result in bad investment outcomes for you. Dave Ramsey promotes the use of actively managed mutual funds. He does this on the basis that strong returns are more important than fees. According to Dave, you should worry less about fees and more about returns.
Here's the thing, listen to this. If your expenses are up 1% higher average over a 10-year period of time, but you make 4% more rate of return, you came out.
I can do that. I can do that.
That's why return is your primary measure of how you pick a fund. That's your primary measure. The last thing I look at is expenses, and very seldom do I find expenses being the deal breaker. And you know, that's the reality.
This is true, assuming that you can find a fund that will have strong future returns. The problem is that, contrary to what Dave Ramsey will tell you, a fund with strong past returns is no more likely to have strong future returns. Let's talk about the real reality. In a 1991 paper titled The Arithmetic of Active Management, Nobel laureate William Sharpe explained, "If active and passive management styles are defined in sensible ways, it must be the case that 1. Before costs, the return on the average actively managed dollar will equal the return on the average passively managed dollar, and 2. After costs, the return on the average actively managed dollar will be less than the return on the average passively managed dollar." Basically, due to the higher average costs, active funds, on average, must underperform passive funds like index funds. Morningstar, an investment research company, has repeatedly studied the usefulness of fees as a predictor of future performance. They have always found the same result. On average, funds with lower fees have better performance. In a 2010 paper on this topic, Russell Kinnell, Morningstar's director of research, wrote the following: "If there's anything in the whole world of mutual funds that you can take to the bank, it's that expense ratios help you make a better decision. In every single time period and data point tested, low-cost funds beat high-cost funds. Expense ratios are strong predictors of performance. In every asset class over every time period, the cheapest quintile produced higher total returns than the most expensive quintile." In a follow-up to this report in 2016, after rerunning the data on fund returns, Kinnell wrote, "The expense ratio is the most proven predictor of future fund returns. I find that it is a dependable predictor when we run the data. That's also what academics, fund companies, and of course Jack Bogle find when they run the data. Vanguard has done similar analysis with similar results." In their 2010 paper, Luck versus Skill in Mutual Fund Returns, Eugene Fama and Ken French point out, "The aggregate portfolio of actively managed U.S. equity mutual funds is close to the market portfolio, but the high costs of active management show up intact as lower returns to investors." There is no question that fees are important, despite what Dave says. In fact, on average, they are one of the most important factors in choosing an investment. But Dave Ramsey does not want you to pick average funds.
And my mutual fund groupings have beat the market. You just pick mutual funds that have outperformed the S&P. It's really not rocket science. Not all of them have outperformed the S&P. A lot of them haven't. Over half haven't. But don't pick one that didn't. You would be better, you know. That's all you're doing when you're picking a mutual fund. Did it beat the market? If it didn't beat the market, then don't pick that mutual fund. That's not rocket science. That horse hadn't won a race.
On average shouldn't matter if you pick above average funds. That seems easy enough. If you pick funds that have beaten the index, maybe the data don't apply to you. It's not rocket surgery, as Dave might say. As with many of Dave's claims, this one does not stand up to the data. Let's start with the SPIVA Persistence Scorecard, a report prepared by S&P each year, which takes the set of funds with the best 5-year track records and then watches them for the next 5 years. If, as Dave says, it is as easy as picking funds with good past performance, then we would expect good funds over one time period to continue to be good funds in a future time period. The Persistence Scorecard takes the top quartile funds for the period ending March 2015 and ranks them through March 2019 to see how many of those top quartile funds remained top quartile for the full 5-year period. The results are fascinating. 0.7% of the top quartile funds remained top quartile. That is 4 of the starting 569 top quartile funds that remained top quartile over 5 years. It would appear, based on this, that picking a fund that beat its benchmark in the past does not help in finding a fund that will continue to do well in the future. The conclusion that we might start to draw here is that strong past fund returns might just be due to luck as opposed to manager skill. In the previously mentioned paper by Fama and French, they examined this exact issue. Do funds that succeed do well because the manager was lucky or because they were skilled? They found that few funds have enough skill to cover costs. Similarly, in a 1997 study titled On Persistence in Mutual Fund Performance, Mark Carhart found that the results do not support the existence of skilled or informed mutual fund portfolio managers. In both cases, the research was examining the ability of managers to add value to fund returns in excess of the returns that a passive index investor could have gotten by passively maintaining exposure to the same types of stocks. For example, if an active manager had persistent long-term outperformance relative to the S&P 500, because 50% of their portfolio was in small-cap value stocks, then they weren't skilled or lucky. They were just taking more risk. This is highly relevant to the end investor, because instead of paying 2% for an active manager, you could have owned a small-cap value index fund for 0.2% or less. I don't know exactly what is in Dave's portfolio of mutual funds, but it would be interesting to look under the hood.
The mutual funds I'm personally invested in, the 4 types I talk about over the last 40 years, have averaged 13.04%. You can't get 12% on your money! I know, I got 13, okay? And the S&P during that time averaged 11.81%, which is real close to 12, stupid people. 30-year, my investments have averaged 11.3. The S&P's averaged 10.89. So I've outperformed the S&P on the 30 and on the 40. Outperformed the S&P on the 20. On the 10-year, outperformed the S&P. Huh.
Sorry, Dave, but U.S. small-cap value stocks have beaten the pants off of the S&P 500 and your funds for the past 30 and 40-year periods. For the 40-year period ending April 2018, when that video was published, U.S. small-cap value stocks returned 15.89% annualized. And for the 30-year period, they returned 13.95%. Index funds in their current easily accessible form were not accessible 40 years ago. But today, it is very easy for any investor to seek higher expected returns in a way that is evidence-based as opposed to anti-evidence. Okay, so fees matter a lot. And flashing the market-beating performance of actively managed mutual funds tells you very little about how those funds will do in the future. More than likely, if an active fund has beaten the market over the long term, it has done so by maintaining consistent exposure to stocks with known characteristics that explain differences in stock returns, like smaller companies and cheaper companies, which you can do using small cap and value index funds at a much lower cost than a traditional active manager. One of the things that Dave says to argue against these realities is that if you look at the actual data on mutual fund performance, about 40 to 50% of active funds beat the market over long periods of time. So you have a pretty good chance at picking a winning fund. The problem with this information, and the problem with mutual fund data in general, is that it is skewed by survivorship bias. Funds that do well, whether by luck or skill, stay alive. Funds that do poorly close down. When you look at the available universe of funds at any given time, you are only seeing the ones that have survived. The Standard & Poor's SPIVA scorecard looks at the survivorship bias corrected performance of mutual funds. For US mutual funds going back 15 years, which is as far back as this report goes, we see that 89% of actively managed funds have failed to beat their benchmark index when we correct for survivorship bias. Ouch! Survivorship bias is a big deal, and ignoring it leads to extremely misleading results. Only 43% of US mutual funds survived for that full 15-year period. It should not come as a surprise that when you look at the funds currently in existence at any point in time, they will all look pretty good. However, this is misleading. Correcting for survivorship bias reveals the ugly but expected truth that active mutual funds rarely beat the index over long periods of time. I am all for financial education and empowerment, and I think that on a lot of topics, Dave Ramsey's advice can be very useful. Unfortunately, Dave's advice on investing could not be further off the mark. There are no good arguments, other than wishful thinking, that investing in high-fee, actively managed mutual funds, regardless of their past performance, will give you a better expected outcome. In fact, the evidence suggests the exact opposite. Low-cost total market index funds are the best investment for most people. Thanks for watching. My name is Ben Felix of PWL Capital, and this is Common Sense Investing. If you enjoyed this video, please share it with someone who you think could benefit from the information. Don't forget, if you've run out of Common Sense Investing videos to watch, you can tune in to weekly episodes of the Rational Reminder podcast, wherever you get your podcasts.